The stock market just did something it hasn't done since 1999. Moody's AI recession model is sitting at 49%, one tick away from a threshold that has predicted every recession for the last 80 years. Oil is near $120 a barrel. The US lost 92,000 jobs in a single month. And yet, most people are still acting like everything is fine. Today, I'm going to show you exactly what Wall Street is seeing, why the average person has no idea what's coming, and the 4 moves you need to make right now before it's too late. Let me ask you something. When was the last time you actually really looked, at what's happening beneath the surface of this economy? Not the headlines, not the highlights on your phone, the actual numbers. Because here's what I've found. Most people don't look until it's too late. And by the time they do, the opportunity to protect themselves has already passed. Right now, Wall Street is flashing warning signs that most ordinary people have never even heard of. And I'm not talking about some fringe prediction from a newsletter nobody reads. I'm talking about Moody's, one of the most respected financial institutions on the planet, whose AI-driven recession model is currently sitting at 49%. Now, that might sound like a coin toss to you, but here's what makes that number terrifying. When this exact model has been backtested over 80 years of historical data, every single time the probability crossed the 50% line, a recession followed within a year. Every single time. We are 1 percentage point away from that threshold, and that 49% reading, that was calculated before the US-Iran conflict, cut off roughly 20% of the world's crude oil supply, and sent prices surging toward $120 a barrel, which means the real number today is almost certainly higher. But let's zoom out, because this isn't just one data point. This is a pattern. The S&P 500 is already down roughly 7% year to date. The Nasdaq has fallen more than 10%. GDP growth has been revised down heavily, from 1.4% all the way to 0.7%. The US economy created just 116,000 jobs for the entire year of 2025, and then lost 92,000 jobs in a single month. Let that sink in. Not a slowdown, not a blip, a reversal. The kind of reversal that economists quietly talk about in rooms most of us are never invited into. And yet, if you turned on the TV this morning, you probably heard something about the market showing resilience. You probably heard someone say we're going to be just fine. That's the gap I want to close for you today. The gap between what the institutions know and what the average person is being told. Here's something that rarely gets mentioned. 79% of North American institutional investors, the people managing nearly $30 trillion in assets, are already expecting a market correction in 2026. These aren't pessimists. These aren't doomsayers. These are the most data-driven, resource-rich investors on Earth, and nearly 8 out of 10 of them are preparing for a downturn. Meanwhile, the average person is still fully invested in the same portfolio they had 2 years ago, with no plan, no hedge, and no awareness that the ground beneath them is shifting. Intellectia AI, and it's not just the recession probability model, the Shiller P/ES ratio, one of the most reliable long-term valuation metrics in existence, is currently sitting above 40.5, which marks the second highest level in market history. The last time it was this elevated, we were heading into one of the most painful periods investors have ever experienced. History doesn't repeat itself exactly, but it rhymes. And right now the rhythm sounds very familiar. Intellectia AI consumer confidence is collapsing too. A March survey found that 65% of respondents expect a recession in the next 12 months, up 6 percentage points in just 1 month. People feel it. They feel it at the grocery store, at the gas pump, in the job market. They just don't have the language or the framework to connect those feelings to what's actually happening at a structural level. That's exactly why this conversation matters, because the warning signs are not hidden. They are not complicated. They are sitting in plain sight, in the data, in the models, in the behavior of the smartest money on the planet. The only question is whether you're paying attention, and if you weren't before, you should be now. Now that you understand the scale of what's being signaled, I want to go deeper, because here's the thing about financial crises. They rarely come from one direction. They don't announce themselves. They don't send you a calendar invite. What actually happens is that multiple pressure points build quietly, simultaneously, until one of them cracks, and then they all crack together. And right now, there are 3 threats building at the exact same time that most people have absolutely no idea about. Not 1, not 2, 3. And each one, on its own, would be serious enough to change your financial future. Together, there's something else entirely. Let's start with inflation. Because I know what you're thinking. We've been hearing about inflation for years now. It's old news. And that's exactly the problem. People have become numb to it. They've accepted it as the new normal. But what Wall Street is watching right now isn't just the price of groceries, it's what persistent inflation does to the Federal Reserve's ability to act. When inflation stays stubbornly above the Fed's 2% target, and right now it does, with signs it's creeping even higher, it ties the Fed's hands completely. They can't cut rates aggressively to stimulate the economy without risking making inflation worse. And they can't raise rates without crushing an already fragile market. That's called a policy trap. And when central banks get stuck in a policy trap, equity valuations compress, borrowing costs stay elevated, and the consumer, who drives more than 2/3 of all US economic growth, starts to suffocate under the weight of high prices with no relief in sight. Now let's talk about something that barely makes the mainstream news, but is sending shockwave through institutional finance right now: private credit. In 2025, US private credit defaults hit a record 9.2%. Let that number breathe for a second. Record highs in private credit. And in early 2026, major firms like Ares, Apollo, and BlackRock began limiting withdrawals or facing serious scrutiny over rising redemption pressures across their private credit funds. Now, this isn't a household name kind of story. Most people have never heard of private credit markets. But here's why it matters to you directly. When default rates spike and large institutions start restricting access to capital, it doesn't stay contained. It spreads into equity markets. Investors start demanding a higher risk premium for holding stocks. That means prices fall. That means the number you see in your investment account starts moving in a direction you don't want it to move. This is how contagion works. It starts somewhere you're not looking, and by the time it reaches somewhere you are looking, it's already too late to react. And then there's the third threat, the one that's impossible to ignore once you see it. Oil. The US-Iran conflict has created an energy shock that analysts are describing as potentially one of the most disruptive in modern history. Barclays has warned that a prolonged disruption in the Strait of Hormuz could knock out 13 to 14 million barrels per day of global oil supply. With prices already approaching $120 a barrel, Oxford Economics believes a global recession would require oil to stay above $140 for just 2 months. 2 months. We are not as far from that number as most people think. And here's what makes the oil threat so dangerous. It doesn't just hurt at the pump. It feeds directly into inflation, which keeps the Fed frozen, which crushes bond markets, which pressures equities, which hits consumer spending, which slows corporate earnings. It's a domino chain. And the first domino is already falling. 3 threats. Inflation locking the Fed in place. Private credit quietly fracturing beneath the surface, and an oil shock with the potential to tip a fragile economy into full recession. None of them are theoretical. All of them are happening right now. Most people are prepared for 0 of them, so we've established what's coming. We've looked at the warning signs, we've pulled back the curtain on the 3 invisible threats quietly building beneath the surface. And now I want to talk about something that might be the most uncomfortable part of this entire conversation. Because it's one thing to know that a storm is coming. It's another thing entirely to realize that you are standing outside with no umbrella, no shelter, and no plan. And that is exactly the position that the vast majority of everyday investors are in right now. Not because they're careless, not because they're irresponsible, but because the information they need to protect themselves is sitting in rooms they were never invited into. Let's start with the most striking number in this entire story. 79% of North American institutional investors, the people who collectively manage nearly $30 trillion in assets, are already expecting a market correction in 2026. Think about what that means. These are not amateur traders on their phones at midnight. These are the most resourced, most data-driven, most analytically sophisticated financial minds on the planet. They have entire floors of economists, quantitative analysts, and risk managers working around the clock. And nearly 8 out of 10 of them are actively repositioning for a downturn. They see a 49% chance of a 10 to 20% market decline. 1 in 5 see the possibility of an even steeper drop. They are not panicking. They are preparing. There is a massive difference between those two things. And while they prepare, most ordinary investors are sitting completely still, fully exposed in portfolios built for a market environment that may no longer exist. But here's where it gets even more specific. And this detail matters. When it comes to oil, one of the most critical economic indicators on the planet right now, retail traders are currently only 45% long on crude. The historical average is 81%. That is not a small gap. That is a 36 percentage point gap between where everyday investors are positioned and where they historically tend to be. What that tells us is that most retail investors are completely unprepared for an energy price shock. And given everything we just discussed about what's happening in the Middle East right now, an energy shock is not a fringe scenario. It is one of the most actively discussed risks among institutional players at this very moment. The smart money sees it. The data reflects it. And yet the average person's portfolio says nothing about it. Now add to that the Buffett indicator, the ratio of total stock market capitalization to GDP, which is currently sitting at a worrying 221%. The last time it approached that level was right before the S&P 500 entered a bear market. And the Shiller P-DOS ratio, which we touched on earlier, is above 40.5, marking the second highest level in recorded market history. These are not obscure metrics invented by pessimists. These are the same tools that some of the most successful long-term investors in the world use to assess whether the market is priced for reality or priced for fantasy. Right now, they are screaming that the market is priced for a level of perfection that the economic data simply does not support. And while all of this is unfolding, consumer confidence has collapsed. 65% of everyday people surveyed already expect a recession within the next 12 months. More than 80% have changed how they shop. Over 40% have actively cut back on purchases. The consumer, the engine of the entire US economy, is pulling back. And when the consumer pulls back, corporate earnings follow. And when earnings disappoint, markets reprice fast. That chain of events is not a prediction. It is a pattern that has played out repeatedly throughout financial history. The insiders are moving. The data is screaming. The consumer is pulling back. The only people who aren't ready are the ones who were never given the information to be. So here we are. We've walked through the warning signs. We've broken down the three threats building simultaneously beneath the surface. We've exposed the gap between what institutional investors know and what the average person has been told. And now comes the part that actually matters. Because information without action is just anxiety. And the last thing I want is for you to walk away from this feeling scared but stuck. So let's talk about what you actually do, not in theory, not in vague, general terms, specifically, practically. Because the people who come out of periods like this stronger than they went in are not the ones who predicted the crash perfectly. They're the ones who had a plan before the chaos started. The first thing you need to understand, and I want you to really hear this, is that the goal right now is not to panic sell. Let me say that again. Do not panic sell. Over the last 11 recessions since 1950, the market has recovered from every single one, not some of them. Every single one. And not just recovered, it went on to reach new highs each time. The investors who lost the most weren't the ones who stayed invested through the downturn. They were the ones who sold at the bottom, locked in their losses, and then watched the recovery happen without them. Timing the market is one of the most dangerous games you can play with your financial future. The data is overwhelmingly clear on this. So before anything else, reset your mindset. This is not about escaping the market. This is about positioning yourself intelligently within it. Now, what does intelligent positioning actually look like right now? It starts with concentration risk. If your portfolio is heavily weighted toward high valuation growth stocks, the kind of names that have driven most of the market's gains over the last 2 years, you are carrying more risk than you probably realize. We saw exactly what happens to concentrated, high valuation portfolios in 2022, when the Nasdaq plunged 35% and investors who were overexposed to a narrow group of tech names watched years of gains evaporate in months. The 2022 bear market is the most relevant recent template for what a rate-driven, inflation-pressured drawdown looks like. And the setup today, in several important ways, rhymes with that period. The move is to rebalance, shift toward companies with strong balance sheets, real earnings, pricing power, and the ability to generate cash flow even when the economic environment gets difficult. Quality over momentum, stability over speculation next. Think about sectors. Historically, defensive sectors. Utilities, healthcare, consumer staples tend to hold their value significantly better during economic contractions. They're not glamorous. They don't go viral on financial social media. But when everything else is falling, they become the most valuable real estate in your portfolio. This is exactly what institutional investors mean when they talk about rotating into defensives. It's not giving up on growth. It's protecting the foundation so that you still have capital to deploy when the real opportunities emerge on the other side of the downturn. And speaking of opportunities, this is the part most people miss entirely. Market downturns are not just threats, they are transfers of wealth. Money doesn't disappear in a recession. It moves. It moves from the unprepared to the prepared, from the reactive to the strategic, from the people who had no plan to the people who built one before the storm arrived. The investors who built generational wealth didn't do it by avoiding every downturn. They did it by being positioned to buy quality assets at prices that only become available when fear takes over the market. That window is coming. The question is whether you'll have the cash, the clarity, and the courage to step in when everyone else is stepping out. So let me leave you with this. The warning has been given. The data is not hiding. Wall Street sees what's coming, and now so do you. The only thing left to decide is what you're going to do about it. And so here we are. We've covered a lot of ground today. And I want to take a moment before we close to bring it all together, because individually, each of these pieces is important, but together, they tell a story that I think every single person watching this needs to understand deeply before they go back to their daily lives. We started with the warning signs, the ones that are sitting in plain sight, buried in data that most people never look at. Moody's recession model at 49%, GDP revised down to 0.7%, 92,000 jobs lost in a single month. The S&P 500 trading at one of its most expensive valuations in recorded history. These are not opinions. These are not predictions from someone trying to sell you something. These are facts. And they are telling a very clear story about where this economy is right now and where it is likely heading. Then we pulled back the curtain on the three invisible threats, the ones building quietly, simultaneously, in the background while most people are focused elsewhere. Inflation locking the Federal Reserve into a policy trap with no clean exit. Private credit fracturing beneath the surface with default rates hitting record highs and major institutions already limiting withdrawals. And an oil shock with the potential to trigger a chain reaction across inflation, bond markets, consumer spending, and corporate earnings all at once. Three separate fires, all burning at the same time, none of them waiting for you to be ready. Then we talked about the exposure gap, the uncomfortable reality that 79% of the most sophisticated institutional investors on the planet are already repositioning for what's coming, while the average person remains fully exposed, underinformed, and positioned for a market environment that may have already changed. That gap is not a coincidence. It is the natural result of a system where the most critical financial information flows to the top first. But now you have it, and that changes everything. And finally, we talked about what to do, because this speech was never about fear. It was never about panic. It was about preparation, about understanding that downturns are not the end of the story. They are a chapter, a painful one sometimes, but always followed by recovery, always followed by new highs, always followed by opportunities that only become visible to the people who kept their head while everyone else was losing theirs. Rebalance toward quality, reduce concentration risk, rotate into defensive sectors, build your cash position, and get ready to be a buyer when fear peaks and prices hit levels that the next decade will look back on as generational entry points. Here is what I need you to take away from everything we discussed today. The people who will look back on this period with regret are not the ones who saw the warning and acted. They are the ones who saw it, felt the discomfort of uncertainty, and did nothing. Because doing nothing is still a choice. Staying still while the ground shifts beneath you is still a decision. And in financial markets, indecision has a price, and that price is usually paid at the worst possible moment. The information is no longer the barrier. You now know what Wall Street knows. You now understand what the models are saying, what the institutions are doing, and what history tells us comes next. The only variable that remains, the only thing that separates the people who protect and grow their wealth through what's coming from the people who don't, is whether you choose to act on what you now know. Markets have survived every crash, every recession, every crisis in history, and they will survive this one too. The question was never whether the market recovers. The question is always whether you are positioned to recover with it. You came here today for a reason. You were already paying attention when most people weren't. Don't stop now. Because the single most expensive mistake you can make in moments like this is to know exactly what's coming and still choose not to prepare. The warning has been given. The knowledge is yours. What you do next is entirely up to you.